In this chapter, we're going to start by exploring the foundations underpinning accounting, such as, for example, why financial statements are prepared in the first place. And we'll finish this chapter by exploring the accounting equation. Now, to be able to analyze financial statements, it's first really critically necessary to understand them. Financial statements are really simply a method of communicating the financial health and viability of an organization to both internal stakeholders, such as managers, and external stakeholders, such as the bank or shareholders. Accounting is sometimes referred to as the language of business. Throughout the life of a business, the accounting processes are intended to identify, track, and record transactions. Now, throughout this course, we're going to encounter many new terms. Well, I'm going to introduce you to terms like debits and credits and journal entries and even something called the general ledger. Each of these contribute to the creation of a business's financial statements. Now, perhaps I should say organizations rather than businesses, because we will learn that there are many different types of organizations that use accounting. Financial statements are a tool used to communicate the financial performance of all organizations and businesses. The format of the information that is being provided in each of the statements gives the user the ability to not only evaluate performance, but more importantly, make informed decisions. Now, one of the key tasks for financial analysts is the ability then to review those financial statements to support financial or investment decisions. Organizations come in all shapes and sizes, and they can also have a wide range of purposes. For-profit organizations aim to generate revenues and ultimately earn a profit for their owners. Alternatively, nonprofit or charitable organizations operate to generate money, typically in order to fund programs, services, or research. Now, both of these types of organizations rely on accounting, but in this course, we're going to focus on accounting for a for-profit business. Profit-oriented businesses can be structured in typically one of three different ways. Let's start with small businesses. Often small businesses start out as what we call sole proprietorships. These businesses are typically owned and operated by a single person who reports their business income on their personal tax return. Partnerships are usually business ventures that involve two sole proprietorships. For partnerships, each owner reports their business income, their portion of the business income, on their personal tax return. Now, the risk of both sole proprietorships and partnerships is something we call unlimited liability. And what we mean by that is if someone sues them, all of their business and personal assets could be at stake. Now, let's contrast that with companies or corporations, which are separate legal entities and they're owned by shareholders. Now, corporations must file their own corporate tax returns and create regular financial statements. Now, one of the main benefits of a corporate structure is something we call limited liability. So if a company or corporation is sued, shareholders are only at risk up to the amount that they have invested in the company. They cannot be personally sued. Now, CFI actually has a course that focuses on different types of business structures in more detail. I recommend, if you're interested, to have a look at that course. The financial statements are a record of the financial activities of a business. Now, there are three key financial statements that we will work through together. So let's have a high-level look at each of these statements. First is the income statement. The income statement is sometimes referred to as the statement of profit and loss, or simply called the P&L. This shows what a business has earned as revenues, what it's paid out in expenses, and what's left in terms of profit or loss for a given period. Now, that period typically will be a year. The balance sheet, also known as the statement of financial position, shows three things. First, what a business owns, and we call those things that a business owns assets. What it owes, and we call what it owes liabilities. And then what's left for shareholders, or what's it worth, and we call that equity. Now, Where the income statement is for a period, such as a year, the balance sheet is like a photograph or snapshot of the business at a particular point in time, typically the last day of that year. The statement of cash flows shows how a business has generated or used cash in one of three different ways: operating activities, investing activities, and financing activities. And the statement of cash flow, like the income statement, is for a period, typically a year. Now that we've had a bird's eye view of the three key financial statements, let's dig a bit deeper into the balance sheet. Now, as the name suggests, the balance sheet must balance. And this is predicated on something we call the accounting equation, which is the foundation of all accounting. The accounting equation basically states this: assets must at all times equal the sum of the liabilities and shareholders' equity. To ensure financial statements are accurate, complete, and reliable, the accounting equation, I can't stress enough, must always be true. So let's dig into the accounting equation in a bit more detail and explore what we mean by assets, liabilities, and equity. So fundamental to understanding the financial statements is to understand how they interrelate as it relates to the accounting equation. Now, as we've learned already, companies have assets, and those are things they own. Now, assets can be things like inventory or equipment or property. Assets have something called future economic benefit, which means they have value that can be used to generate profit, or they can be sold off and liquidated to cash. Liabilities, recall, are what the company or business owes. Now, companies can owe amounts to vendors, suppliers, customers, and creditors like banks. Finally, equity is often referred to as shareholders' equity, and you can think of it as the residual value of the company. So imagine this: a company or business could liquidate all its assets and get cash, and then pay off all its liabilities, and the cash that's left would be with the equity. That's why we call it the residual value. Now let's look at owning a home to try and explain the accounting equation in a bit more detail. So let's imagine you have a home that's an asset that's valued at $1 million. But you also have an outstanding mortgage with a bank on your home for $750,000. So that's a liability. Your equity in your home would be the value of the home at $1 million, less the mortgage of $750,000, leaving you with equity of $250,000. In other words, if you sold your house and paid off the bank, you would be left with a residual value of $250,000. Now, over time, the equity of a business will increase through contributions to the business, maybe by issuing more shares or stock, and also by generating revenue and creating profit. Equity will decrease over time from things like increasing expenses or net losses, or through the payment of dividends to shareholders. No matter what happens, the accounting equation must always be true. The balance sheet must always balance.